SCHD has been on an absolute tear the last couple of years, and there's a reason why everyone is talking about it. Over the last 10 years, it's had an average return each year of 13.5%. It has a dividend yield of 3.29%, which is absolutely crushing the S&P 500. The S&P 500 is also down 14%, while SCHD over the same time period is only down 4%. Now, we all know that SCHD is the king in the dividend ETF space, and if you don't know that, you should definitely check out this video that I'll link down below. I did a deep dive on why SCHD is one of my favorite ETFs, but I'm not going to go over that in this video, so watch that afterwards. In this video, though, I am going to go over 4 of my favorite ETFs that I think are on pace to possibly crush SCHD within the next 10 years. Near the end of the video, I'm going to give you my ideas of where to invest in these and how to invest in these, as far as in what order and in what accounts, like a 401k or your brokerage. What's the best way and what's going to make you the most amount of money and get you towards that financial freedom quick. My name's Nolan Govea. My students call me Professor G, and I made this channel to make investing simplified. Now, these are in no particular order, but first up on the list is one that I'm sure you've all heard of, and if you haven't heard of it, it's one that you definitely need to know. VYM is the Vanguard High Dividend Yield ETF, and it tracks the performance of the FTSE High Dividend Yield Index. The index selects high-yield dividend-paying companies based in the US, excluding REITs. This fund is passively managed, which means it has super low fees, and it's highly diversified with over 440 individual company stock in the portfolio. The largest industry holdings are financials, healthcare, and industrials. The top 10 companies within this fund are ones like Johnson & Johnson, JP Morgan, Home Depot, and AbbVie. The expense ratio is super low at 0.06%, and on average for the last 10 years, it's had an average appreciation of 11.6% every single year. So this fund has been killing it. VYM has a dividend yield of almost 3%, and today the ETF's price is $111, and over the last year, it's down only 2.8%, which is actually better than SCHD. Now, this one is the model of consistency. Nothing particularly awesome about this fund other than the fact that it is consistent, it is sustainable, and that's what we're looking for when we're looking to invest in dividends long term, because you want to expect a passive income check every single quarter, and you don't want anything messing with that. The second ETF is one that I'm sure that a lot of you know as well, because it has been getting a lot of hype lately, and even if you do know about it, you may not know all these details. So I went ahead and did a deep research dive for this specifically, because this ETF is super cool. JEPI is the JP Morgan Equity Premium Income ETF, and quite astonishingly, it pays out a 12.39% dividend. Now, you guys know that I'm pretty skeptical about these high dividend yielding payers, and so when I saw that crazy dividend, that definitely threw a couple red flags for me, and so I investigated deeper for you. Because if this is as legit as it looks, this is a game changer. For example, if you invest in a dividend fund with a 3% dividend, you'll need about $400,000 invested in order to have $1,000 of passive income each month. With a fund that pays a 12.39% dividend like JEPI, you'll only need $96,852. That's quite the difference. The other big difference is that this fund is paid out every single month rather than quarterly. Now, to be transparent, I'm still learning a lot of the info that I'm about to share, and so for those of you that are watching this that know even more than I do, it'd be super awesome if you go ahead and throw that down in the comment section, anything that I missed or something that might be able to help somebody else, even if it's on one of the other ETFs. I would love for this to be more of like a community base, to where you're not only learning things from me, but maybe you're learning things from other people in the comment section. So be respectful down there, but also let's help each other out. All right. That was my professor voice. Back to it. So this is actually a covered call ETF, so they're actually a pretty complicated structure. Options are very complicated and risky, so one of the things I like about investing in this ETF is that you have professional option traders doing the work for you, and you get the somewhat less risky benefit. They use an ELN structure that lets them write covered call options on the S&P 500, and they are then able to make a fee on top of these options. ELN means equity linked notes. To simplify this strategy a little bit, what they're basically doing is, if they write a covered call using the ELNs, they get to charge a fee with that, and so if they make $100 a profit, they'll take $50 for themselves as profit and pay out that other $50 to us as investors. That's how they're able to give out such a high dividend, one that's way higher than any of the actual companies that are within the fund. They have mostly stocks from the S&P 500 with the goal of holding very low volatility companies so that keeps their risk low as well. Now, something that was a red flag for me is that JEPI isn't terribly transparent about exactly how the ELNs are used. And for me, when I'm investing in something, I like to know everything about it, or at least know that I can look it up and find whatever it is that I care about. So this is something that I'm going to dive even deeper into, and it's got a little bit of a red flag for me there. And anytime options is involved, it's obviously higher risk with the goal of higher reward. And most people that I know of invest in this as a portion of their dividend investing portfolio and not as like the only thing that they're investing in because of the risk. And the other thing that gives me a little bit of pause is the history or lack thereof of the fund. It's only been around since 2020, and it has done really well since that time, but that's a very small sample size. And me as an academic definitely want to see a lot more data to be able to make up my mind about this one. The largest industry holdings here is pretty evenly distributed, with the highest in industrials, healthcare, information tech, and consumer staples. The top 10 companies in the funds are ones like Progressive, Exxon, and Coca-Cola. The expense ratio is a little bit higher because it's an actively managed fund, not like VOO or SCHD, which are passive. So this is a higher expense ratio of 0.35%, which I don't think is that expensive, especially for how high that dividend actually is. If that dividend can stay consistently up above that 12% range, this is a steal. It obviously doesn't have 10-year data, but the data we do have is quite good. Since inception, the fund has returned over 13% per year. The price of JEPI is a little over $55 per share, and over the last year, it's down 10.5% for the past year. So this is definitely one to watch and research further. This next one, in number 3, is a very exciting one because I love the strategy aspect of it. DGRO tracks the US Dividend Growth Index from Morningstar, which is a dividend dollar-weighted index that seeks to measure the performance of US companies selected based on a consistent history of growing dividends. One of the things that's a little bit different about this fund too is that it has small, medium, and large cap, whereas a lot of funds only have that large cap. So the diversification on this compared to the rest of your portfolio is probably pretty strong. Another thing that I really like about this fund is how they pick their stock. The DGRO screens for 5 years of uninterrupted annual dividend growth to identify the universe of dividend growers. It looks for paid out dividends not exceeding 75% of earnings, which narrows in on companies likely to continue growing dividends. And it looks for dividend yields not in the top 10% of the investment universe, so as to reduce exposure to companies with unsustainably high dividend yields. And that last one I look at as a positive and a negative, but I'll go over that in a second. The largest industry holdings are healthcare, financials, and information tech. Top 10 companies are ones that we've seen before, like Exxon and Home Depot, but then also super attractive growth companies such as Microsoft and Apple. The expense ratio on this one is still low at 0.08%. This fund's only been around for 9 years, since 2014, so it has a 5-year average return of about 10% every year. It does only have a dividend yield of 2.27%, which is pretty low today, but the goal is growth. The price of DGRO is $51.41, and over the last year, it's down 7%. Now, I do like DGRO a lot, and I like the investing thesis on this, especially for long-term growth, but there's two things that I don't really love. First thing is obviously that dividend is pretty low. The second thing is that I don't really like that they screen to take out the top 10% of dividend yielding stocks, especially when this is a dividend fund, because then that takes away companies like Verizon or Altria, and these companies have a beautiful dividend, but since they're in the top 10% of that dividend yield, we don't get to take part in it if you're invested in DGRO. I would say the way you look at DGRO should be the same way you look at JEPI, in that it should be a portion of your portfolio and definitely not your whole portfolio. All right, this next one in number 4 has a super high dividend yield, and it's one that can definitely stay sustainable in my opinion, based off of the way that they pick their companies that are within the fund. Now, this ETF picks the top 80 companies with the highest dividend yields in the S&P 500. So it's definitely good companies, solid companies that are relatively safe and that are in a very strong index. This one is the SPDR Portfolio S&P 500 High Dividend ETF, or SCHD. The largest industry holdings are financials, utilities, and real estate, along with energy and consumer staples. It has a solid list of top 10 companies, with ones like Principal Financials and Chevron. Since inception in 2015, it has had an average return of almost 9%. It has an expense ratio of a very low 0.07%. The current price of SCHD is $41.58, and over the last year, it's down almost 6%. Now, this ETF has a dividend yield of over 5%. So it has a very solid dividend, it has a low fee, and it's kind of a mix between those high yielders and those high compounders. So this looks like one that's sustainable long-term, but also will still have growth and produce amazing cash flow. After doing much research, this one has definitely creeped up my list. And now we can all agree that ETFs are just a very smart way to invest. But people usually get the order of how to invest or where to invest all mixed up, and that costs you thousands, if not hundreds of thousands of dollars. I made this quick video to show you the optimal order and how you can invest your money today, and how to take true advantage of the amazing opportunity of ETFs to get you closer to financial freedom now.